All right, everyone. Well, thank you for joining us. Thank you, Melissa, for the introduction. I do want to go ahead and highlight again the JMT as our sponsor. JMT Consulting, obviously focused, independent, innovative, and proven. Just to reiterate some of the housekeeping notes, if you do have any questions, please don't hesitate to add those to the questions box. We will be sure to save a little bit of time here at the end to address those questions. So again, thank you for having us today. And my name is Andrew McCown. Today for the agenda, we are going to, as the session mentioned, we're going to introduce you to the new lease accounting rules. Now, as you can see, and as an overview, we're going to talk about what's changed, and we're going to define a lease and talk about a little bit about the slight nuanced differences in the definition of a lease. We're also going to take a look at identifying if there is a lease. So we're going to talk about the steps that you need to walk through. One of those is going to be that concept of control, which is a very technical definition. We're going to lead into embedded leases. Embedded leases are going to also be something that really has always been around. It's not new to the new standard, but it is getting a lot more attention because of the way the requirements make you report more, and therefore some of these embedded leases that you've had in the past may have not gotten the attention and actually not even made it into the prior reporting for leases. However, now there's going to be more focus there. We will then wrap up with discount rates, which is another hot topic. Again, these are really the larger, hotter topics of this new standard. And then finally, talk about some myths and pitfalls, as LeaseQuery specifically has been involved in over 1,000 implementations of this new standard. So we have a lot of experience seeing what is and isn't true, as we've heard a lot of things leading into the projects and after the projects. Now, to get kicked off, we do have a polling question. And I just really want to ask this for everyone's understanding. I'd like to get an idea of where you stand personally as what do you know about the accounting rules? You don't have a clue, that's why you're here. You know a little, but need to learn more. You're dangerous, but wouldn't go on Lease Accounting Jeopardy, or you know everything about the standard. So we'll give you about 30 seconds there. And again, this will allow me to understand how technical I can expand on certain topics as we work through the webinar today. We do have a question. What is LeaseQuery? Is this a marketing session for the tool? LeaseQuery is a tool. This is not a marketing session for that tool, however. We are going today to talk about the lease accounting standards and what's changing, but LeaseQuery is a solution for the new lease accounting regulations to help with that. But today is not that specific session. But we'd be glad to help set you up on a session to review the solution if you'd like to see it. So I think we can take a look at the poll results.
Looks like almost everyone has voted. Andrew, are you able to see the poll results, or do you want me to read them out to you?
All right. All right, so it's looking like we've got a pretty good mix of knowledge here. So we'll do a dive into all the different topics at the medium level, I'll say. So we'll just jump right in at this point. So again, as I mentioned, we're talking about the new rules. So we're going to begin with the definition of a lease. Now, under the old rules, and you'll hear me refer to the old rules and new rules today a lot, that's going to refer to 840, ASC 840, and ASC 842. So ASC 840 are old, ASC 842 are new. Now, these are the FASB's accounting standard codes and the number, okay? So 840, again, old rules, 842, new rules. Now, under the old rules, as you can see here in the slide, a lease existed if you had either the right to control the use of an identified asset or you obtain substantially all of the economic benefit. Under 842, this has actually become an and statement, as you can see highlighted there and underlined. Now that's important because that's going to preclude certain agreements that were considered leases before won't qualify as a lease under the new rules, and we'll talk a little bit more about that. So I do want to jump into the identification of a lease. And as we work through the identification of a lease, I want to make sure you know that this flowchart here, it's available within the guidance, it's available on our website, a bunch of different places, but this is something that something like this is something you'll want to reference as you're getting into the new lease rules. So why is that? Well, the reason is this flowchart you actually need to assess every single lease to determine, or every single agreement you have, excuse me, to determine if it has a lease. Because one of the practical expedients that the boards have given to help us in this transition to the new rules is that you don't have to reevaluate your old leases. But that is assuming you have already done this evaluation. And quite frankly speaking, most people had not performed this evaluation in the past. So it's still best practice to go through this evaluation on all of your leases, even if you're confident in the ability to understand where the leases lie. Is this contract, is this an agreement, a lease? So the first thing that you're going to have to cover, is there an asset involved, as you can see at the top. Now, if the answer is no asset at all, then you don't have a lease. So when you take a look at the flowchart here, the first thing is an asset involved? You say, yes, there is an asset. It could be a machine, it could be a location, it could be a lot of different things. Now, when you take a look down one level, you have implicit or explicit identification. So let's talk a little bit about that. When you take a look at identification, you have the explicit or the implicit. Now, explicit identification is just as it sounds. It is named. So within the agreement, machine ABC, serial number XYZ is going to be available. That is explicit. This bus, that floor in the building, all those things are explicit. The last mile, for example, of a pipeline, explicit. But when we talk about implicit, it gets a little more complicated. What type of asset would be implicit in an agreement? Well, one example would be a specific type of truck or rail car, for example. Maybe you have an agreement with a transportation company and you're a food services group, and you're sending refrigerated goods. Well, you know that your goods have to go on this specific rail car that has this technology, and it must move your goods. Now, in the agreement, it doesn't say all of that, but based on your agreement, that is what has to take place. That is an implicit asset. You have the right to use and control and direct the use of that asset. And therefore, that's going to be a lease. Now, again, a lease, and we'll talk a little bit more about this as we get into the embedded discussion, an agreement could be a lease. But just because something says it's a lease necessarily at the top of the document does not make it a lease. So again, it's about the content. So that's explicit and implicit identification. So now we know what the asset is. Now we know, what do we get access to? What are we benefiting from? So that's the first step. So we can cross that bridge and we can jump back to our flowchart. So we say, yes, we have an asset. And at this point, we've identified if it's implicit or explicit. Now, before we move on, implicit and explicit, we need to understand, do we have a right of substitution. And again, we're going to take that after we've identified asset. And after we've identified the asset, then we must understand that these criteria are met. Now, if this is true, if these two criteria are true, then that asset is not identified. Again, this is the identification discussion here. We're talking about, we've said it's this asset. Now we need to determine, do we control the asset? Do we direct the use? So before we even get into that, again, in the chart, direct use and deriving benefits and control, does the supplier have the ability to substitute this? And the two things that have to be met that determine if the supplier has that ability are that there are alternative assets available and that giving you, the lessor, or excuse me, the lessee, giving you a different asset to fulfill the agreement must also benefit the supplier. What does this mean? So let's just jump into our rail car example. We implicitly identified we had this frozen rail car, or this refrigerated rail car that was one of the, maybe the only ones, or we knew this rail car was going to move our goods. And then the supplier said, you know what, we actually have 10 rail cars that meet those specifications. And you know, the one that we were shipping your goods on, or that we had implied we were shipping your goods on, that one actually gets down to 0 degrees. And the one, and your container only needs to maintain 30 degrees. So, you know, we're going to go ahead and take this implicit asset effectively that you were using. We're going to use it for another job, and we're going to make more money from it. That's going to benefit us. So we are now substituting. They have a right of substitution to give you another asset, and that substitution right benefits them. Now, if they could just simply say, well, we have 10 refrigerated rail cars and we can give you any one of them at any time, but there's no benefit to the supplier for substituting those, effectively, you still have an implicit asset. So again, the supplier here, the lessor that you are working with, has to have alternate assets available, and to make that change with you, it must benefit them. If it doesn't, you still have a lease. Now again, a lot of times in the past, in the old standards, this is really where the workaround came in. What happened was the lessor would say, yeah, we can substitute all this stuff. And you go, okay, well, great. Then we don't have a lease. And so that allowed the lessee to get out of it. So again, I want to mention something that came in the basis of conclusions. It's number 129 related to ASU 2016-02, which is the leasing standard, ASU, the update. The basis of conclusion says that really this condition, this substitution criteria, it is really meant to help explain that this is a supplier controlled asset versus a customer controlled asset. And again, this is how you do it. Are there alternates available, and will it benefit them? So again, now we've talked about the implicit or explicit asset, and then if the supplier has the right of substitution. If both of those are true, we're going to keep moving. We still aren't sure if we have a lease, but now we get into directing the use and deriving the benefits. So when we talk about directing the use, the first thing we're going to talk about is control. So when we talk about the control test, we want to make sure that customer, as it says here, is able to direct how and for what purpose the asset is used. So directing how, that's directing the use, right? And for what purpose is really leading towards obtaining those benefits, right? You'll notice here, while you will have the ability to direct the use, direct how something is used, and for what, there are a few things, a couple of them here, that won't exclude you from saying, I don't have control. So the first one is I wouldn't say obvious, but after you talk about it, it sounds pretty obvious. The protective rights of the supplier doesn't preclude the customer from having a right to direct the use. So you may have a lease of an airplane and they say you can't fly it in this controlled airspace. Again, protective right. It's not precluding you from directing the use. Also, if the decisions are predetermined, then customer may control the asset if the customer designed it or if they operate it. So one example here, as far as when you start to think about, well, what is control and what is precluded as control, what's excluded, think about a crane. So you may lease a crane to build a project, to build a building, and within that, the company that you lease it from is going to build the crane on your site. They're going to provide the crew to operate the crane. However, and that crew, they're going to operate as you control, as you determine how and when. Now you can't move it, and the crane cannot be moved in an unsafe way. You can't say to the crew, swing this around here, if that's not a safe movement. So that is a protective right. The supplier is protecting the crane, they're protecting their people, but you have the right to control how and when. So that is still a lease. You have control in that case. So that control part, again, is very important because it allows you to understand that you have the ability to control the asset. Again, you now have an asset, and in the new rules, you have a right to use the asset. Whereas in the past, we just simply had an obligation to pay to utilize the asset. Now, again, that is the control part. That is directing use. So if we take a step back, we take a look at our flowchart, and we're down now. We have the ability to direct the use? We do. So along with that, we're going to move down, and we're going to take a look at deriving all the benefits. So again, we're still in this concept of control, okay? And at any point, if we have a no throughout this flowchart, it directs us to not having a lease. So we're still in the lease, and we're going to walk through now, do we get the benefits? What are the benefits? How do you determine that? So the benefits are going to be your primary outputs and byproducts, just like it says here. It's going to exclude things which would be related to ownership, right? Now, how much of the benefits? Do we derive all the benefits is what we had in our flowchart. Well, in fact, the language that's written in the agreement, or in the standard, excuse me, not the agreement, is substantially all. However, the FASB did us a great common service, I would say, I guess, if you're familiar with FASB guidance. They did not define substantially all within this guidance, but they have defined it in other areas, and substantially all is a concept within accounting and technical guidance that typically means 90% or more. So are you getting 90% of the output from any machine, any pipeline, any data center, things along those lines? That's where you've got to think. Are you getting all of the output? Are you getting access to substantially all of the economic benefit? And if you are, well, then you have a lease. Again, just like we've talked about in the flowchart, as we're working through, we check all these off. And as we get through, we understand that we have an asset. We understand that we have the identification, implicit or explicit. We understand that there is no substantial right of substitution. Again, there may be the ability to substitute, like we discussed, but it would not benefit the supplier, so they don't have that substantial right. We have the ability to direct the use of the asset. And then finally, we're also going to get all or substantially all of the economic benefit. We have a lease. Now, to further this conversation, we're going to talk a little bit more now about those embedded leases. Now, An embedded lease. And again, as I mentioned at the beginning, an embedded lease is not a new concept. It is not a new thought. It really is very similar to the embedded lease language under the old rules, which again, as I mentioned, topic 840. However, the entire old standard did not give the attention to leases it deserved, which is ultimately the reason we have a new standard, 842, which makes everything more clear. But one of the problems is with the old rules and the old standard, we had the embedded lease information. We were supposed to evaluate all of our contracts, but because the lease disclosures and the commitments, there's the footnote in our disclosures weren't getting the attention that everyone expected or wanted them to, embedded leases weren't getting the attention. So why spend all this time reviewing our contracts to determine we owe $25,000 more over the next year, when that's all that really would have been the impact of identifying an agreement that was an embedded lease. However, with the new standard change, we have this massive impact, because if you haven't evaluated your agreements and determined that they were even leases from the beginning, from the old rules, they should be on the balance sheet tomorrow under the new rules. In which case, you're going to have potentially millions of dollars, if not just thousands, but millions of dollars that need to be on the balance sheet. You need to have that right of use asset. You need to have the lease liability. So again, this isn't a totally new concept, but it is new to a lot of accounting groups, as the amount of investigation that is required, documentation and process that need to be in place to ensure we are tracking and accounting for these embedded leases properly. So the first common question when we start talking about embedded leases is, well, who has embedded leases? Who functions under this? Well, everybody has embedded leases, unfortunately. It's really, again, going back to the point I made earlier, that if you have a contract, an agreement with a firm, a company, whatever of the likes, any contract may be a lease. Just because it says service contract at the top doesn't mean it's not a lease, or doesn't mean it doesn't have a portion of that agreement that is a lease. So the entire agreement may not be, but there may be areas of the agreement that classify as leases. Similarly, but different, on the other side of that, a document may read lease agreement at the top, but in practice, in fact, it's only a service contract. So again, it's not so much the title of the agreements as the content. And so when we look at what organizations are impacted, as I mentioned, all. Now, these are just some examples from banking to government entities. When you start to think about it, well, where are these? Well, you look at banking, you have ATMs. That's pretty identified, but the land the ATMs sit on may not be. In manufacturing, you have all types of agreements, from warehousing, like you see it with logistics. So maybe a warehouse agreement to have store stuff in a certain amount of space, that may actually have a carved out area within a warehouse. So you actually technically have a lease of that corner of the warehouse, things like that. Within energy, oil and gas, you may have pipeline agreements. You may have, and there may be capacity involved in those. So you need to understand, is it substantially all? Are you receiving it here? How much are you getting there? Healthcare, you may have agreements to service a certain machine, right? While the agreement may read service the machine, you really start to dig into it and you realize, oh, guess what? This is a lease. We have an agreement to buy all of the masks from said company, but the masks only work with this machine, or this accessory only works with this machine. So we're going to buy all this from them, but it's because we're using this asset. And oh, by the way, that asset is a lease now. We have control of it, we use it. It is our asset. So again, all organizations impacted in a number of different areas. So where do you find them when you talk about an individual organization? You've got to look everywhere. You've got to leave no stone unturned. Because again, part of the evaluation and transition to the new rules is making sure that you had a good handle on it under the current rules. And so when you think about that, again, you need to go back and review potentially agreements that have never been reviewed. So you look at your logistics contracts, you look at your transportation agreements, you look at your warehousing agreements, data center, right? You may get all of the capacity of a data center, a specific data center, and therefore you actually are leasing this data center. You've really got to get in. The data center ones get really complicated because when you start to talk about the substantive right of substitution, you've got to talk about, well, could they switch out this server for another server and that benefit you or benefit them because they can charge more to a different client, things like that. Those really start to get complex, the embedded leases around those types of agreements. Again, ATMs, like I mentioned, it could potentially be the space on the ATM or the actual machine. So supply chain, that really catches a lot of these under one umbrella: logistics, transportation, warehousing, and such. There's all different types of agreements, supplier agreements that are going to come into play that may impact your portfolio. So that's important to make sure you're looking at all areas really of your supply chain and the agreements and contracts that you get into, and evaluate those to understand if there is actually a lease within that. And then finally, internet, another common one. For example, you may move into an office space and you need so much internet, you need a dedicated line. So maybe from the street to your building, that is 100% your line for internet. That may actually be a lease. So there's things to consider related to all of the different services that you may be utilizing as a business. And who should be involved, right? So we're talking about the embedded lease analysis. Everybody. I hate to say that, but on a certain level, everyone needs to be aware, I should say. Maybe not necessarily involved in the process of evaluation. That may be left to accounting or somebody that has control of the contract bank or the contracts within the business. However, you really need to uncover the areas of the different agreements, because a lot of times supply chain will just enter into new agreements, or real estate will sign a new lease, or procurement will make a supplier agreement final before maybe running it through the accounting group to determine if this actually has an implication on the balance sheet. So, a lot of these are things that probably never happened in the past. And another one of the problems that we see many companies undertake as they start this project and work through the project is simply that they don't know where all of their leases are. They've never really had a central repository. A lot of different areas of the business do get involved in leasing practices. And again, because I sound like probably a broken record, but because the old standard did not require as much visibility to the leasing practice within a business, the businesses did not, quite frankly, have a great reason to consolidate everything, to centralize everything, and to really have a good handle on it. Unfortunately, when things like COVID happen and we have these life-changing events and business changing, quite frankly, we've seen a lot of people realize how beneficial it may be to have something in place, to be able to forecast spend and things like that, rather than just have the expenses that come up for these agreements. So again, you really want to make sure everyone is aware. Again, as far as the analysis goes, you're probably not going to have them all involved in that, but you do want everyone to be aware of the new standard, aware of the rules, aware of the impact of the agreements that they're entering into, and just really educate them on what to be thinking about. Another thing to think about when they're getting into these agreements. Just to give you a few keywords here. Now, again, there's no silver bullet for embedded leases, but you'll see things like exclusive use, see words like solely or identification number, things like that you will see more commonly. And again, that's just going to help you take an agreement and say, all right, let's look at this a little closer. There's nothing better at the end of the day. I hate to say it. We get questions all the time. How are you reviewing these? What are you doing to understand that this is embedded? Well, it's a manual process. There are systems out there. There are companies out there that claim to have AI that can read a lease and output the necessary information. We haven't found one that we feel is sufficient enough to trust. Any that we've reviewed, we still have found errors in and want to again, manually intervene anyway. So we found that it to be most efficient to know what you're looking for and process those rather than have a robot do it, as these agreements are so unique and they are not cookie cutter and they are not standard, so much so that interpreting meaning gets lost a lot. There's a lot lost in translation. So again, no silver bullet, no magic tool that's, you know, $50,000 that'll just handle this for you. Unfortunately, the most tried and true is going to be the manual intervention here, the manual review of those agreements. So that's a little bit on the embedded leases. Again, we walked through how to identify a lease in that flow chart. We also, again, highlighted some of the nuances here to where you'll find some of these agreements where they have embedded leases. We also do have, Lease Query has a free tool on our website, which you can click through and help yourself identify if an agreement does have an embedded lease. So we're moving on here. We're going to get into some of the more technical areas outside of identification of the leases and the embedded leases. We're going to talk discount rates. This is, well, yeah, I'll go ahead and say it. This is probably the most asked about topic that we get. And the real reason is the confusion and the difficulty of finding this number and obtaining this number, and the fact that, again, going back to the standard and the FASB, they didn't do us a great service in where we're going to get this information or how, but just told us that we need to have it. So when we're talking about discount rates, one size does not fit all. As I'm sure many of you are aware, the standard asks for the implicit rate. So you'll see on the left there, the implicit rate is what is required by the standard. Now, you'll also notice on this screen, WACC, weighted average cost of capital, with a big cross through. You may be asking why. Well, that's one thing we commonly hear asked about. Can we use our WACC? Can we use our weighted average cost of capital? Is that number going to suffice? And quite frankly, the answer is just no. The weighted average cost of capital includes more than you should in obtaining that rate. You aren't including that cost of capital. You need a rate that is relatable to the amount being borrowed or the asset being borrowed, the fair value of the asset borrowed, not the rate at which your company, your overall company, can borrow money. So that's out. Now, we'll talk a little bit about some of the things we've seen people do, but the WACC is out. Now, IBR, that's what everyone should use, provided you don't have the implicit rate. Now, the incremental borrowing rate is supposed to be for who? Well, it's for what, I should say, pardon. It's for a collateralized loan and the amount of the fair value of the asset, of what you are leasing, of what you're borrowing. Now, where do you get that? Well, you're going to have to go to the bank. You're going to have to go to a loan officer. You're going to have to ask somebody, say, hey, I want to borrow $50,000 for what? Well, for this Ford F-150. Oh, okay. Well, you're buying $50,000 for this asset. Well, that's going to be a 4.3% rate. Okay. And that's difficult. And that's something that not everybody has the ability to get that number, to ask their bank, to understand that. So one final note to this page is the risk-free rate. Now, the risk-free rate, as you can see, is only available for private companies. It is one of the practical expedients. So again, the risk-free rate is not available to public companies. They've already adopted. It is, however, available to private companies, and it relieves you from the need to worry about implicit or the IBR. But we want to talk a little bit more about each of those before we get into some of those final myths and pitfalls. So let's talk about the implicit rate a little bit more and really understand, A, what is it, and B, why can't or why won't or why don't most people use it. Implicit rate is simply as it's explained here. Present value of the lease payments and the present value of the unguaranteed residual value. The combination of those is going to equal the fair value of the asset plus the lessor's initial direct cost. Now that sounds pretty simple. But what's wrong with this here? What's wrong with this is we don't have this information. So yeah, if we had all the data, calculating a rate is pretty simple. But if the lessor were to give you the present value of the unguaranteed residual, their basically expected residual, and their initial direct cost, they probably wouldn't be in business, because that'd be giving you a great insight or a great view into the margin they're making on you as a lessor. So while this is in theory a great idea to have this implicit rate, if lessors were giving this away, they wouldn't be in business. So again, at times we've seen it, it happens. There are plenty of agreements where there is a rate stated implicit. That is not the more common scenario. That is the uncommon scenario, and most often you'll never be able to calculate it, as you will not have the information necessary to make that calculation. So where does that take us? Again, we skip by that WACC because that's not allowed. And let's talk about the incremental borrowing rate. As I mentioned, this is going to be the rate the lessee would pay to borrow on a collateralized basis over a similar term equal to the payments in the same environment. So again, that's very wordy, but again, it's the rate that a bank or a borrower would offer for you to borrow that asset. It's pretty simple in theory, but again, when you start to talk about all of the conversations that you're going to need to have, that you're going to have to ask, where you're going to have to go to get this data, this isn't something that's just something you Google or find, right? You have to get these numbers. So what we've seen, quite honestly, other than everyone asking and finding this, is a lot of companies have built synthetic curves. And so, with that, they've built a model that does take into account their borrowing habits and their rates, and they've built a curve that they can plot and pick off of based on the term and the value of the different leases they get into. So that's one thing that some companies have done. But that's the IBR. Again, that is what should be used, provided you don't have the information needed for the implicit rate, which is most common, so you should find yourself here with the IBR. However, as I mentioned, we did discuss there is that option for the risk-free rate. So when you're taking a look at the risk-free rate, you want to say, well, who can elect this? So it can be elected by private companies, not public. We do have a question referencing nonprofits. Yes, you also can use the risk-free rate. So the risk-free rate can be elected by non-public business entities. So again, in this case, we are talking private companies, nonprofits, and the ability to use a risk-free rate, which is, as you can see here, the rate of return of an investment with no risk, right? Now, this can't be elected for IFRS, so we can throw that one out. This is a FASB expedient. And you'll notice here, we also put a resource for these rates would be on treasury.gov. So this sounds great. You've got a risk-free rate. It's easy to find. It's easy to apply. However, there may be some reasons why you don't want to use the risk-free rate, and we're going to talk about those here briefly. So what's the impact of the risk-free rate when we start to think about this? Why would you elect it? So over here on the left, well, the obvious one is it prevents having to do the complex calculation for the IBR. It prevents you having to ask your bank. It prevents you to having to try to calculate the rate implicit. It really eliminates those concerns. Why would you not elect it? Well, let's think about that. Well, the first one, the liability is going to be higher. You're calculating the present value of your payments. That's a part of this new standard. You're going to have a big old liability, and it is going to highlight how much you owe. Well, We know a little bit about present value around here, and everybody in accounting and in finance knows when you have a lower interest rate, you're going to have a higher liability. The higher interest rate is going to discount your present value more. So if you're looking at the IBR and maybe 4 or 5%, you say, wait a second, my present value, my liability is 10 million. Well, you go to 0% or point something percent risk free, that liability may be 13 or 14 million. So again, the liability may be higher. And then second to that, your company may plan to go public. And guess what? If you're planning on going public anytime in the future, you're going to have to backtrack and rewind and undo and rework. So even if there's no direct immediate plans for it, if it's a thought in the future, you may not want to elect that because it's just going to cause so much work in the follow-up from that. So again, very, very helpful option, great expedient for those private and non-public entities, but a couple of things to consider as you are making that election and that determination. So now we're going to talk about, to wrap up here, we got about 15 minutes left. I am going to leave about 5 minutes or so here at the end for questions. So by all means, we've gotten a few questions throughout, so keep those questions coming and we'll take a look at those and address as many as we can at the end of the presentation. But when we talk about myths and pitfalls, I just want to give you an overview of really where we're gonna go. And again, having worked with and helped over 1,000 companies to this point through this transition, we've seen a lot of problems, but we've seen a lot of successes, and we really have seen what's worked and what hasn't. And so again, we're just going to go through the impacts, the impact of all leases or all assets. Is that a myth or pitfall? The exemption for low value, which again gives you a little more introduction to some of the nuances. Is this affecting our debt? How will EBITDA be impacted? And that we've got a lot of time left to get ready for this. So let's go ahead and just jump through these. First one, the scope of this, the new lease accounting standards impacts all leases of all assets. Well, this one's true, but there's some false to it, I guess. There are certain leases that get excluded. So it does include all leases unless you're intangible or short term. So intangibles as well as living assets. So as you can see, timber, livestock, things like that, not going to be lease. However, you will exclude those. You'll also exclude short term. Now, short term is something that we get a lot of questions on, and we didn't include it as a part of the changes here because, again, this is sort of under the lines of it's not really changing as much so as the attention that's being brought to it is important and is a lot. Any lease that is less than 12 months or 12 months or less as of commencement is going to continue just to have the 840 accounting treatment where you straight line and don't have to create an asset and a liability. Now, the common question there is, well, what if I have a 12-month lease that I just continue to auto renew? And that's very common. That question is easily addressed. There is a area of the standard that says if you are reasonably certain that you will renew, that needs to be included in the term, and therefore your term is not short. It is not 12 months. So that's a quick solve for that one. It's really where most people are trying to play games, and that clause there really prevents the ability to play that game, so to speak, where you just have a one-year agreement for everything and renew it. So all leases are included with a couple caveats. That's not a myth. That is the truth for the first one. Now, the second myth here is that there is a low dollar value or their low dollar values can be excluded for per 842. That is totally false. There is no materiality threshold within the 842 standard. There is a materiality threshold within accounting in general. Everyone's aware of that. And there is also one in the international lease accounting guidance, which I believe is part of the reason why we get the question so often, what is the threshold with FASB and GAAP? Now, again, as I mentioned, I'm not sitting here to say materiality doesn't exist and there aren't thresholds to be set up, but there is no explicitly stated threshold in 842. So company by company, case by case, you can make those determinations, you can get those understandings, and you can really define what that threshold is or isn't going to be. Myth 3 coming up here, that 842 is going to expand my debt. So we've briefly talked, and again, most of this has been about the changes to identifying the lease, but at a high level, we've mentioned you're going to bring the liability and you're going to bring an asset onto your balance sheet related to those leases that you never had before. So the immediate thought is, oh my goodness, my ratios, my debt covenants, everything are going to be out of whack. That's not true. Now, there are some caveats, and we're going to talk about those here. But at that statement, that's a false myth. It's just simply not the case. Why? Well, this is why. 842, operating lease, operating liability. So it's stating that we're not going to include those in debt covenant financial ratios. Now, finance leases, this has not changed. Again, I feel like a broken record, and to some extent I am. Under the old rules, we had a finance lease. Under the new rules, you're going to have a finance lease. That is not changing. So that continues as is. There shouldn't be any effect of the new standard changing the debt there. Now, all that said to say, what do you need to do to ensure this doesn't happen? Again, as I mentioned, this is the facts. But at the end of the day, you may include some of those things in those ratios. You may have already, believe it or not, your loan company, they may have already calculated some sort of liability that they're using from your commitments. So when we take a look at this, I want to mention that many loan agreements and arrangements contain frozen gap clauses. So if there is a change in gap, a change in the financials related to a change in gap, it won't constitute a default or will require both parties to negotiate. So that is something that is an option that you may want to look out for. You may want to review your covenants and check on that. What we've seen from the facts of the matter is that private companies less commonly have that type of information in their agreements, so be sure to review those. Again, if this is going to change any ratios or leverages, get ahead of it. I want you to make sure that you know that this isn't going to impact you. And the only way to do that is to really get into the weeds here and really start to understand, how is this impacting my financials? How is this going to affect those ratios, if at all? So again, you got to get into the leases, you got to get into some of these calculations, and quite frankly, you probably want to do this even before these calculations need to be reported. Again, we talk about the timing of all this, and we talk about the ability to understand this, for example, and say, listen, this needs to be reviewed. You need to talk to your finance department. You need to talk to your CFO, whoever that may be, the controller. You need to make sure that you've got a handle on this so you don't come across any surprises. And then the fourth myth, which is EBITDA. Now, I know a lot of you aren't necessarily tracking EBITDA, but for those of you who are using a similar measure, earnings before interest, tax, depreciation, and amortization, it's before all of those things, right? It's not going to impact it. There is no direct impact to the EBITDA. Now, that is precluding you'd had no changes in classification. Again, old standard, new standard, how it was classified under the old rules can maintain that exact same classification provided it was correct. So when you transition to the new rules, there should be no impact on EBITDA. However, as leases do get renewed, as leases do get reviewed, if you come to the conclusion that they need to now, that classification has changed or something has precluded a change in the lease, that may impact the EBITDA, but that is not because of the standard, okay? Just to be clear on that. And then finally, the last myth is that you have plenty of time. Now, I will give you this: you have a lot more time than you ever had. Well, that's true, and it isn't true at this point. The standard originally was set to go into place at the end of last year, and that got pushed back in the middle of last year for private companies till the end of this year. Well, as we're all aware, we are in a very unique situation having to deal with the pandemic, and that has caused the FASB to forgive more times, to allow more time. So now, rather than implementing it right now, quite frankly, and being ready to go here at the beginning of next year, you now have until the end of next year, which is great from the standpoint of now you have time. Maybe I should have changed this. The myth is that that you have plenty of time. The truth is that you have time, not necessarily plenty. So whether you like it or not, the standards are coming. It's imperative to get started. Hopefully, as we've talked through some of the differences today, you realize there are a lot of questions that you need to ask before you really get into the weeds of the new standard. There's potentially a team you may need to pull together, or areas of your business you need to reach out to, or you need to survey, and you need to say, let's get a handle around this. Maybe this fourth quarter is a great opportunity to start those surveys, because guess what? Now that we have been afforded this time, we don't have to have it ready before the end of next year, but we can prepare now so that, say, at the end of the year end, and once we come out for air at the beginning of 21, we have a nice plan in place to tackle this project over the next 6 or 8 months to lead into the end of the year. So that's the final myth. Again, you have plenty of time, but the time that you have is going to go quickly, and we haven't seen anybody solve this, I would say, quicker than anticipated. In the past, it always takes a little more time than you'd expect, whether it be analyzing those different specific leases or reviewing the agreements to determine you already have the correct calculation and everything that goes with that. So again, there are a lot of steps that go into this in a lot of different areas. So for the final polling question, I did want to mention or ask, would anyone, or when would you like to review the lease query solution? Immediately would be in the next month or so. Soon would be before the end of this year to help plan for next year. If there's an incentive to see the demo, I'd probably take a look. Never, I'm not interested in seeing a demo of the solution, or never, I never want to see a solution there. So that is going to be the end of our presentation. We can go ahead and everyone please answer that poll. I did want to mention, if anybody did answer, if you would like to give me an incentive to see the demo, I would love to offer $500 off if you see a demo before October 16th. If you would, email Adam Waits at leasequery.com and reach out. We'll also be sure to follow up from this webinar with the recording. But I do, as we are at the end of the time here, we have a few minutes, I want to take a look at some of the questions. So we do have a couple of questions here. Obviously, some of them are housekeeping. One is, will the slides be provided? Yes, we will be sending those out, as well as the recording. The nonprofit, that was a question asked about, would you be able to use the risk-free rate? That absolutely is the case. We had a question about the balance sheet. So how will this look on the balance sheet? That is a really good question. Quite frankly, it's not as easy a question to answer within the time that we have. However, I will say that within a demo, you'd be able to see that. We can also have a ton of content on our website that is very educational. We have a resources page where you can take a look at a example start to finish of the new rules and actually get numbers to paper. So you will be able to understand that that is definitely something that we'd be able to show you and highlight. So we'd be glad to do that on a demo. So that about wraps the webinar up today. Again, I do want to thank everyone for joining us. Just final housekeeping. If you have questions, please don't hesitate to reach out to myself, Andrew McCown, or Adam Waits. Our contact information will be within the deck here. And finally, I would just like to thank JMT Consulting for allowing us to participate in this webinar and present to you all today. We really appreciate the opportunity, and we look forward to working with any of you as the opportunity permits. So thanks for joining us, and have a great day.